If you're going to make an important, potentially life-changing financial decision, please don't base it on something you read in the Sunday papers. There's a bit of a Twitter storm brewing today. It's following an article published in the Sunday Times and then a couple of tweets from their chief money reporter, Ali Hussein. In this video, I'm looking at why you should never rely on the Sunday papers or what you read on Twitter when you're making important decisions about your future and your family's future. Hi everyone, I'm Martin Bamford. I'm a chartered financial planner, personal finance YouTuber and money author. On this channel, I talk about personal finance, investing and happiness. I make these videos to help you become wealthier and happier. If that sounds like a great result, go on and click on that little red subscribe button. Become part of our subscriber community. It's completely free and you'll never miss an episode. Before I dive into this one, I should really caveat it with a bit of context around the part that I play when it comes to financial journalism. I'm not a journalist, but I have spent a great deal of my time in the past 20 years or so contributing to the stories, articles and features written by money journalists. In a typical year, I speak to 200, 300 journalists providing quotes, comments, analysis for their pieces. That's relevant because money journalists are not, for the most part, experienced financial advisors or even qualified in financial planning. They do work closely with money experts, experienced financial advisors like me when writing stories. I know a handful of journalists who have taken some of the professional exams, and I take my hat off to them, but the majority just haven't subjected themselves to the rigorous examination of their knowledge and competence that your typical financial advisor has. With that said, and keeping in mind that my personal philosophy is to play the ball and not the man, I won't dwell too much on Ali Hussein's experience and qualifications. His LinkedIn profile shows that he's got 16 years experience working for News UK, that's the owner of the Sunday Times, and also a degree and master's degree in English literature and a postgraduate diploma in journalism. He's never worked as a financial advisor, to the best of my knowledge has never taken and passed a financial planning exam, but he is a very experienced journalist. With that said, let's take a look at this article together before we move on to the arguably more contentious tweets that accompanied it this morning. Thanks to Dave and Phil, by the way, for sharing the article copy with me when I asked for it on Twitter earlier. I did try and buy a copy of the Sunday Times for myself down at our local Londis corner shop, but they had sold out by this afternoon, so very helpful to have it via Twitter. This story is about someone being described as a retired financial advisor who has somehow ended up with 30 life insurance policies since taking out the original policy all the way back in 2001. The headline claims that 78-year-old Eric Marshall has watched his premiums rise from £158 to £1,500 a month to maintain the same level of cover. This is a whole of life insurance policy, and I need to explain the difference between this and the term assurance that you're far more likely to have come across in your financial life. Whole of life insurance is life insurance without a fixed term. So regardless of when you die, assuming you've been continuing to pay premiums and the policy is still active, the insurance company will pay out the promised sum assured. Allow me to get slightly morbid for a moment. We all know our dates of birth, but none of us know our dates of death. But what we do typically know is the duration of any given financial risk. For example, the term of our mortgage. If you know that your mortgage term is, say, 25 years, then it's entirely reasonable to get a life insurance policy with a 25-year term. Likewise, if your kids are born today, then a term assurance policy that lasts for 18 or 21 years can make sense. You match the duration of the insurance with the duration of your risk. But the duration of some risks are unknown. Let's say, for example, that you want to put some insurance in place that will pay your children a lump sum of cash designed to cover their inheritance tax bill when you die. Or more commonly, when the second partner in a marriage dies, because that's when the inheritance tax bill gets triggered. That's an example of when whole of life insurances come into play, because you don't know when you're going to die, and the term of the insurance therefore needs to be open-ended. Pop yourself in the shoes of the insurance company for just a moment. It's not a very pleasant place to be, I know, but it's important. With a term assurance policy, the risk and therefore the cost of providing insurance is lower because it's a known term. The chances of you dying in the next 20 or 25 years is actually quite reasonably low, of course, depending on your health and age. But the risk of you dying one day is, well, it's 100%. I'm sorry to break it to you, but you are going to die one day. What whole of life insurance policies typically had, and this seems to be the experience of the Sunday Times reader here, is a reviewable premium. And the way this works is that the premium is fixed at a set monthly amount for the first 10 years of the plan, and then it's reviewed based on your age at the time of the review and some other factors too. Those factors include the number of claims the insurer expects to pay, their return on investment, and I'll come to that in a moment, expenses, tax and regulations, and the cost of reinsurance premiums in the wider commercial insurance market. So premiums get reviewed after 10 years and then again every 5 years. If you want to maintain the same level of cover, it's reasonable to expect that your premiums go up at each and every review. And you can expect the premiums to increase significantly from age 70 onwards. And that's because the probability of dying actually increases significantly from age 70 onwards. The older you get, the more chance there is that you're going to die within that next 5-year period, and therefore the greater the risk to the insurer. Okay, you can step back out of the insurer's shoes now. I promised to talk about investment returns, and you might be thinking, what? This is about an insurance policy, not an investment. What's Martin going on about? But just to complicate things, whole-of-life insurance policies contain an investment element. They are not investments, although some people in the past have used them as investments, but they contain investments. And this is why we don't really like them very much as financial advisors, and why some of Ali Hussein's comments were quite so offensive. Anyway, broadly speaking, whole-of-life policies used to be sold on what's called a maximum cover basis. That's where your insurance cover is linked to an investment fund. If the returns from that investment fund were good, it helps to keep the cost of premiums down at each review. And over time, you build up an investment fund within the insurance policy, and you can even cancel the cover and take the cash if the surrender or the encashment value makes sense relative to the sum assured, the amount that would be paid out when you die. With those explanations in place, turning back to the article in the Sunday Times, the retired financial advisor took his whole-of-life policy out in 2001 with an insurance company called Scottish Provident. They were subsequently bought out by Phoenix Group. It had a premium of £158 a month and a sum assured or death benefit of £150,000. So far, so good. But this was 20 years ago. So the reader would have been through 3 premium reviews by my calculations, 1 at the 10-year anniversary and then 2 5-year anniversaries since then. And as a result of those premium reviews, the total monthly cost has shot up to just under £1,500 a month. It's important to mention that the sum assured has gone up too, not by quite the same magnitude, admittedly. It's risen from £150,000 to £371,000, and it's risen by virtue of an inflation link, something that's quite a common option with these policies. The way this old Scott Prov whole-of-life plan worked was to issue new policies at each premium review, to do so to maintain the total life cover amount, hence the reader ending up with 30 policies in total now. Reading through this article, it appears that the reader has got a few complaints, a few problems, a few issues with this insurance policy. One is clearly the cost. £150 a month to £1,500 a month is no small beans, but it's also what we might expect in terms of insuring a 78-year-old. And not a 78-year-old in good health, by the way. Oh no, because he had a quadruple bypass back in 2004 and then a heart valve replaced in 2016. He's also recovering from prostate cancer. The reader, Mr. Marshall, is what we might refer to in the insurance world as a bad risk. Now, according to the ONS, the typical 78-year-old man in the UK will live, on average, until 88 years old. That's an average, remember, and averages do hide a wide range of outcomes. And it's an average life expectancy for somebody who hasn't undergone major heart surgery twice or had prostate cancer. This bit then really gets my goat. The article makes it sound like he's one poorly puppy. And in that situation, having life insurance in place is a very valuable thing for your family, because there is no chance of getting new cover at that age and with those underlying health conditions. In fairness to the journalist, the article does confirm that a new policy would be prohibitively expensive, and I think that's a very kind assessment. I don't think that you would realistically find an insurance company prepared to underwrite that particular risk. The article also highlights another complaint, another issue, that these types of policies perform badly, carry high charges, and have built-in commissions paid to non-existent advisors. Well, yes, I can't argue with any of that. The investment fund choice with these policies was always pretty rubbish, and the funds themselves, they tended to underperform. As with all insurance, the charges are opaque and pretty much impossible to separate out from the cost of the insurance premium. We do know that in the early years of these policies, most of the premiums actually went to the original advisor in the form of a commission payment. And on this subject of commission, yes, that's a fair criticism too, because these are old legacy products sold at a time when financial advisors were paid commission to sell insurance products. It's unclear from the article whether Mr. Marshall sold himself the life insurance policy back in 2001, but he's being described here as a retired financial advisor. I know that the press do like to refer to lots of people as financial advisors, even accountants and things, so I'm not sure if he was a financial advisor as we understand the term, but perhaps he should have known better. He certainly should have understood the likely magnitude of premium increases as he got older and the way in which the investment element and the surrender values might work. But I don't have all of the facts to hand, only what I've read in the article in the Sunday Times today, so I'll reserve judgment on that particular aspect of it. But I do need to talk about Ali Hussein's tweets this morning. He tweeted this when he shared the article on Twitter. In the first, he said, "A life insurance policy is like a pact with death. You might as well invest those premiums. That way, you're better off the longer you live, not the other way around." I was genuinely surprised to read this one. It's hugely irresponsible. I think it demonstrates a serious lack of understanding. What Ali seems to be suggesting here is that we self-insure rather than use insurance policies to mitigate risk. And yes, in some circumstances, self-insuring is a reasonable thing to do, but for most people, it's a very, very bad idea. What happens if you die before you build up anywhere near enough money to support your family? It's a very dangerous strategy, and I'm disappointed that an experienced financial journalist like Ali would suggest such a thing. The language he used is terrible too, a pact with death. We all die. Referring to life insurance as being a pact with death is a bit like those people who talk about not making a will because they think it will result in them dying. We all die. In his second tweet, Ali writes, "Financial advisors love to sell these insurance policies. It's one thing that can still earn them commission. In some cases, the customer can't turn the fee off. So beware those who peddle them." The first part of that statement is utter twaddle. I started practicing as a financial advisor back in 2002, and I stepped back from the client-facing role only a few years ago. And in all that time, I think I probably recommended one whole of life insurance policy, and it had guaranteed premiums, not reviewable ones, and it was for inheritance tax planning purposes. And of course, it was on a nil commission basis. I charged a fixed fee for my advice. I don't know any financial advisors who are routinely out there selling these, and I know a lot of financial advisors. In fact, advisors are often criticised for not selling enough life insurance products. It's often said that insurance has to be sold, it's not bought. Nobody wakes up in the morning and thinks, I should buy some life insurance today. We might buy it because we've experienced a close call with death or a loved one's passed away unexpectedly and it prompts us to do so. But the real reason that people buy insurance, it's because competent financial advisors are doing their jobs. They're identifying the risks, they're recommending solutions that mitigate that risk. There are already so many reasons why people don't buy enough insurance. There are popular misconceptions, including that insurance companies will do everything they can in their power to avoid paying out a claim, and it's nonsense. The facts and the figures just back up the reality that actually close to 100% of insurance claims are paid out successfully. If you disclose everything when you fill in the application form, if you don't hide any material information from your insurer, then they will pay out when you die, or with a critical illness policy when you're diagnosed with a specified critical illness. These things work. I hate to see articles and tweets like this because it can result in people having their lives utterly ruined. People trust journalists. When they read their articles or their tweets, they take action. If one person cancels their insurance policy or decides not to take out life insurance as a result of Ali's article or tweets, that's a travesty. It's why I'm pleased to see so much pushback from the advisor community today on Twitter, rubbishing both the article and the tweets and exposing them for what they really are, dangerous. I'm not happy, of course, to see the handful of advisors who are playing the man and not the bull. But in the main, advisors seem to be sticking to the facts and explaining how this stuff actually works, why it's so important to have. Journalists have a powerful platform. They reach really big audiences. Even my most popular YouTube videos and podcast episodes don't have the reach of the Sunday Times. It had a circulation as of September 2019 of about 660,000. But that's changing. The way we consume information is changing. But do keep in mind this is information. And there is a world of difference between information, guidance, and advice. When you read stories in the weekend papers or tweets from journalists, they are not advising you. How could they? They don't know you. They don't know your circumstances, your goals, your objectives. And that's why only a financial advisor or a financial planner can deliver advice. What we've read today in the Sunday Times is a throwback to a legacy product, poorly explained, and used as a springboard to rubbish an incredibly valuable foundation of financial planning, life insurance. Don't get misled when you read stuff like this. Like any good journalist does, go and check your sources first. Make sure you understand who you're taking advice from, who you're listening to when it comes to your information. If you found this video helpful, there is one super quick thing you can do right this second to support my channel, and that's smash the like button. And if you fancy being an even bigger supporter, why not share this video with your social network or with a friend who you think would get something valuable out of watching it? Press that share button now. Thank you for watching this video. Until next time, I'm Martin Bamford. And remember, when it comes to your money, the more you know, the faster it can grow.